What if I told you there's an investment vehicle that promises you mailbox money, tax benefits, and a piece of a multi-million-dollar property, all while you sit on your couch in pajamas? Sounds like a dream, right? But here's the uncomfortable question we need to ask. Who's actually getting rich in a real estate syndication? You or the guy with the pitch deck? Let's set the stage, because syndications have exploded in popularity over the last decade, with billions of dollars flowing from everyday accredited investors into deals run by operators known as general partners or sponsors. The pitch is simple. You bring the capital, they bring the deal, and everyone, supposedly, wins together. But here's where the machinery gets interesting. Because the sponsor typically collects an acquisition fee, an asset management fee, a disposition fee, and a promote sometimes called carried interest, all baked into the structure before you see a single dollar. Think of it like hiring a chef to cook dinner at your house, except they charge you for walking through the door, touching the stove, plating the food, and then take the best bite for themselves. Now, to be fair, syndications were once the exclusive playground of ultra-wealthy institutional investors. And opening that door to the masses was genuinely revolutionary when platforms and operators began democratizing access in the 2000s and 2010s. There was real optimism, real excitement, and honestly, a lot of people did make real money during the low interest rate, rising rent, appreciating market environment of the last decade. But then rates went from near zero to over 5% faster than most sponsors had modeled in their underwriting, and suddenly those conservative projections started looking like they were written in crayon by an optimist at a bull market party. Capital calls started going out, distributions got suspended, and the phrase, "we're navigating a challenging macro environment," became the sponsor's version of "the dog ate my homework." The psychological hit here is real, because passive investors, many of whom were doctors, engineers, and professionals who trusted the process, watched their mailbox go quiet while the sponsor kept collecting asset management fees on a struggling asset. One investor I came across described it perfectly. "I thought I was buying a piece of a building, but what I actually bought was a front row seat to watch someone else get paid to manage my loss." Historically, real estate has rewarded patient capital. And that's not a myth. Through recessions, corrections, and rate cycles, going back to the 1970s and 80s, real property has generally recovered and created wealth over long enough horizons. But the critical distinction is between owning real estate and owning a slice of a highly leveraged, fee-laden structure designed by someone who eats before you do, regardless of performance. Here's the pattern that keeps repeating, and it's almost poetic in its predictability. Markets run hot, sponsors underwrite aggressively, investors pile in chasing yield, rates or vacancies shift, deals stress, and the sponsor's fees remain contractually protected while the investor's preferred return quietly disappears. We've seen this in the savings and loan crisis, in the 2008 collapse, and frankly, in dozens of syndications that quietly imploded between 2022 and 2024. Let's kill the biggest misconception right now, which is the idea that being a limited partner means you have limited risk. Technically true in a legal liability sense, but practically, you can absolutely lose your entire investment while the general partner walks away having been paid along the way. The passive and passive investing doesn't mean protected. It means you're trusting someone else's judgment, execution, and integrity with your capital. So does that mean syndications are a scam? Absolutely not. There are operators with stellar track records, transparent fee structures, strong alignment of interest, and a history of protecting investor capital through multiple market cycles. The difference between a good deal and a bad one often comes down to three things: the sponsor's skin in the game, the conservativeness of the underwriting assumptions, and whether their fees require the deal to perform or just to exist. Here's the practical playbook if you're going to play in this space. Underwrite the sponsor harder than you underwrite the deal. Stress test their projections by asking, what happens if rents are flat for 2 years? And never let a polished investor portal or a beautiful pitch deck substitute for a direct conversation about how they've handled a deal that went sideways. Moderate exposure, meaning no more than 10 to 15% of your investable net worth in any single syndication, is the discipline that separates the people who build wealth from the people who fund other people's wealth. Position sizing is everything here, And the investors who've navigated this space successfully aren't necessarily the ones who pick the best deals. They're the ones who spread their bets, stayed liquid, asked hard questions, and treated syndications as one tool in a diversified strategy rather than the whole strategy. Conviction is seductive, but process is what actually keeps you in the game long enough to win. At the philosophical level, real estate syndications are a mirror reflecting how well you understand alignment of incentives, and the uncomfortable truth is that most fee structures in this industry are designed to be profitable for the sponsor, whether you make money or not. That's not evil, that's just business. Your job as an investor is to find the rare operators where their financial outcome is genuinely tied to yours. We're not saying don't do it, we're saying do it with eyes wide open, a spreadsheet that you actually stress tested, and the emotional maturity to size your position for a scenario where everything goes wrong and you're still financially okay. The market will cycle, opportunities will emerge, and the investors still standing will be the ones who prioritize preparation over FOMO. If you walk away with one thing today, let it be this. In a syndication, the promoter is almost always going to be compensated. The real question is whether the deal is structured well enough that you get compensated too. Discipline, sizing, and consistency aren't just investing principles, they're the difference between building generational wealth and funding someone else's. And whether the market corrects, stabilizes, or roars back, the investors who win over time are the ones who stayed rational, stayed educated, and never let a slick webinar replace real due diligence. We're comfortable with any outcome as long as our preparation was honest and our exposure was intentional. If you want to go deeper on any of this, whether that means finding the right syndication partners, exploring direct real estate investing, getting connected with home contracting work, or finding the right lenders for your next move, check out all our links in the description below and let's help you build something real.